Okay, so hi there, welcome to the second in our just little double header, introducing you to the economics of the currency market. You cover exchange rates and currencies in much more detail in the A-level course. This is just a taster, and what I thought I'd do in this video is just think a little bit about what causes the value of a currency to move higher, what might cause the value of a currency to go down in the markets, an introduction to currency trading. One way of thinking about this is to ask the question, well, who is in the market, let's say the pound against the dollar or the pound against the euro, who's in the market buying or demanding pounds or sterling in the currency markets? They need to exchange one currency for another, and the currency deal involves buying pounds. Well, lots of people potentially. Investors are important in the currency market. We sometimes call them speculators, and the key point, the absolutely key point to take away from this video is that investors tend to buy or demand the currencies of countries where the risk-adjusted rate of return is highest. If you're going to put your money into a particular currency, there's a risk, isn't there? The risk that the currency could fall in value, so you get less when you convert back. The risk that you put your money into a stock market where the values of shares rises and falls, or the bond market ebbs and flows. So you're looking for a rate of return. You want to make money by putting money in the currency markets, but you also have to take into account the risk of doing so. So money tends to flow into those currencies where the risk-adjusted rate of return, the expected return, is highest. Now, who's buying sterling? Well, typically, overseas buyers of exports will be purchasing sterling. If you're an American car company, for example, a car showroom company, and they're trying to sell UK cars in New York or in California, if you're going to bring cars from the UK to sell in the States, you'll have to sell dollars and buy pounds to make that purchase. It could be, for example, American tourists or European tourists come to London or come to Edinburgh or York on holiday. They'll be selling their own currency and buying pounds to stay in hotels and eat in restaurants. So whenever the UK exports a good or a service, typically that involves a demand for currency. We also have in the market currency speculators who are simply there because they think the value of a currency can rise or fall, and they tend to go long. In other words, they're buyers of currencies whose value they expect to go up. And there are also other investors expecting the value of sterling to rise. For example, people might be deciding to buy property in the UK. They might be looking to make an investment in the UK stock market. Perhaps they could be a purchaser of a government bond issued by the British government. So typically the value of sterling, the demand for sterling, reflects the inflows of overseas money as investors and importers want British goods and services. Conversely, who's selling sterling? Well, when you buy an import, you typically sell pounds, you pay for the import in pounds, but eventually it gets converted into dollars, euros, yen, or Chinese yuan. Currency speculators, for example, may be selling pounds because they expect the pound to fall, to go down in value. And other investors might be starting to unwrap, take their money out of the UK economy. Perhaps they expect a deep recession or a deep fall in the markets, and they're going to sell their sterling assets and maybe buy assets in other countries. All of these things involve currency exchange, and this is on the supply side. Here's a little thought experiment for you. I'm going to give you 3 economic headlines, and all you have to do is think about and then decide which way you think the currency might move. In this case, it's going to be sterling. Do you think sterling will move higher or lower on the back of these 3 headlines? New figures show a deeper than expected recession in the UK. Will sterling appreciate or depreciate? The United States Central Bank decides to cut their interest rates to 0. What might that do to the UK exchange rate? And the new forecast shows London house prices are expected to fall by 20%. Will sterling appreciate or depreciate? So this is the moment to press that pause button to have a little think about these questions, and then we'll go through them together when you're ready. So here are 3 headlines. Which way do you think the pound is going to go up? Do you think there's going to be a net demand for pounds, in which case the pound will rise in value? Or do you think there's going to be a net outflow of sterling from the UK, in which case the pound will depreciate? First headline, new figures show a deeper than expected recession. What's the impact? Well, other things being the same, we'd expect the sterling exchange rates to depreciate. Can you think of the reasons why? I mean, typically if there's a deep recession, UK output, for example, we found in April 2020 fell by 20% just in 1 month. Well, if the UK economy is in a deep recession, then you might expect, for example, that the profits from UK companies might be falling, or that the UK stock market might be taking a hit. In which case, if you've got money invested in the UK, you're not going to get the same return from that. You might be better off moving your money out of the UK into currencies of countries perhaps less impacted by the coronavirus pandemic. What about our second one? The United States Central Bank decides to cut their interest rates to zero, effectively a fall in the rate of interest on deposits in the States. Sterling in this situation would probably go up. You see, money tends to flow into countries where the expected return is highest. And if you're thinking about where to put your savings, if the United States has cut interest rates effectively to zero, you're not going to get a very good return by putting money on deposit in bank accounts in the States. So typically people might move their money out of the States into the UK, for example, or Switzerland, or whatever it is, another country perhaps where the rate of interest is higher. And as people move their money out of the dollars, the dollar will fall and other currencies will go up. And our third example, forecast shows London house prices expected to fall by 20%. Consequence for sterling? Probably a fall in sterling, because if the housing market is taking a big downturn, there would be perhaps a fall in the number of overseas buyers of London property attracted to the market. Perhaps they might come in later on when the prices have fallen, but it's likely that the overseas investor demand for housing would go down. Therefore, there's less demand for sterling to buy property in London. Now, there's lots of subtle nuance here, lots of uncertainties. No one factor on its own determines the currency. It's a complex mix of economics and politics and other factors as well. Just in terms of the interest rate, let me go through that again. If the central bank cuts interest rates, it was our second example, wasn't it? Investors expect lower returns from deposits in banks. Therefore, there tends to be an outflow of money from the banking system. Some of this money moves overseas. Investors, as they move and shift their money overseas, they sell that currency, they tend to buy others. Other things being the same, the currency tends to depreciate. Now, this has just been a quick introduction to explaining currency values. If you're taking A-level economics, which I hope you are, you'll be looking at currencies and foreign exchange in much more detail. It's a fascinating and really important topic.